Mutuality Forum. We are so glad that you have joined us. The theme of our conversations today will be the future of performance management. I'm Amanda Catherine Roman, and I'll be serving as your Master of Ceremonies for the event. Yesterday's speakers shared personal stories and examples of making tough choices in order to align with their company's purpose. We heard of personal leadership practices for action and accountability, as well as operational processes that can better support leaders in this transition to the next era of capitalism. Today, we will dive deeper into business management practices and learn about the accounting and reporting frameworks that purpose-driven leaders need to measure and drive superior holistic value creation. To help us start that exploration, I would like to take a few moments to introduce my colleague, Colin Mayer, a standout leader in this arena who has helmed this effort at Oxford University for a long time. Colin is an acknowledged expert on all aspects of corporate finance, governance, and taxation, the regulation of financial institutions, and the role of the corporation in contemporary society. He works on the nature of corporations, the regulation of financial markets and institutions, international comparisons of financial systems and corporate governance, as well as the effects of the financing and control on corporations. Alongside his academic research through Oxford University, he is active in many aspects of financial study and practice. Welcome, Colin.
Amanda, thank you very much indeed for the introduction. It's a great pleasure to be introducing day 2 of the forum. And the focus of today is on the subject of measurement. One of the most significant developments that's occurred over the last few decades has been the summarizing of the performance of business in a single measure, namely share price. It's the single driver of the largest businesses around the world, where companies are private and not listed on the stock markets. It's measured by profits. So share prices and profits are embedded in everything: business school teaching, business practice, and financial investment. They're clear, precise, observable, and actionable. Action by linking every aspect of incentives of organizations to them: remuneration, promotion, firing, and hiring. The last 60 years have seen progressive intensification of share price and profit-driven incentives. Stock options, fair value and mark-to-market accounting, financialization, hostile takeovers, and hedge fund activism. We've reduced the world to a single measure of performance. But this preoccupation with the beauty, simplicity, and clarity of share price and profits has been very unfortunate. It's a reductionism ad absurdum. It's driving the world to a point of climatic collapse and social fragmentation. We're seeing the consequences of that all around us. What's wrong with this single measure? The answer is simple. Profits and share prices are wrong. They're entirely incorrect measures of what they purport to report. They don't measure either the profit or the value that a company creates. They don't take account of the value of the benefits that a company creates or the destruction it causes. How can we record a profit where a company has earned it from destroying part of a rainforest, cutting down an ancient woodland, accelerating the extinction of species, employing people at below living wages, selling addictive products, avoiding paying their fair share of taxes? Those aren't profits any more than the earnings of a burglar stealing someone else's property. It's theft, but its only distinction from theft is that we've legalized it. Not only have we legalized it, we've encouraged and immortalized it by incentivizing it and honoring the wealth that is accumulated from it. Like a patient preoccupied with their temperature, we've created an addiction, not just to the addictive products that are the source of share price increases, but to the share prices themselves. Furthermore, we've gone on to suggest that anything else is a muddle, confusion, impractical, and inefficient, a distraction from the simplicity of share prices and profits. How could we have possibly got to this point? I could give an academic answer and say that the beauty of the economic models has driven a false belief in the power of competitive markets, the efficiency of financial markets, and the ability of regulation to constrain bad behavior. I could give a sociological answer and talk about the power of vested interests in preserving the status quo, where a small elite benefits at the expense of others in the natural world. I could give a historical explanation in terms of our enthusiasm for Adam Smith's Wealth of Nations while forgetting his theory of moral sentiments. But there's a more fundamental reason. We've forgotten why we are creating and running businesses. It is not simply to profit. It's to solve problems that you, I, and societies and the natural world face. And in the process, to produce profits. Profits are critical and vital. Without them, we won't have investors, and without investors, we do not have the financial resources we need to solve problems. But profits are not the purpose, but the product of the purpose of solving problems. It's a simple confusion of cause and effect. Solving problems are the cause, profits are the effect. The reason this distinction is so important is that we need to ensure that we're not profiting from producing problems. By ensuring we're not producing problems, we're incurring the costs of avoiding, mitigating, remedying, and compensating for them. But even this is not enough. It's no longer enough to avoid causing problems. Net zero will not do. People are looking to business now to proactively solve problems. And as your brilliant book, Poole, says, it's not about net positive. It's now about being net positive. It's not just the costs of avoiding, mitigating, remedying, and compensating for detriments and problems that companies need to incur, but the costs of solving problems. That is what defines a true profit of a company. Companies need to innovate in finding ways of addressing the world's toughest problems profitably. And if companies do not know how to do it, then they need to partner with others to help them to do it. We need not just to recognize our purposes and the true cost of delivering them, but we also need inspirational leadership to achieve it. As we heard in yesterday's session, we need cooperative, collaborative leadership rather than just the competitive, destructive leadership of the past. That is what makes for true profit and shared as well as share value. Paul, I'd love to get your thoughts on the importance of measurement and some of the issues that surround it. Over to you, Paul.
No, thank you, Colin, and certainly it resonates 100% with what you are saying, and I can recommend to the people that want to know more about it to pick up Colin's book, Prosperity, which it's too young to be called a classic, but it certainly is something that is absolutely a must reading. First of all, happy December, Colin, because we've just hit the 1st of December mark, and I hope that this month will be important for at least recharging the batteries for many people and being with dear ones and celebrating, because we all need it as we have some tough challenges ahead of ourselves. We often say we treasure what we measure, and whilst it's not that all the important things can easily be measured, we certainly can measure most of the things that are important now. The measures that help us focus, align, help steer the choices, allow comparability, create transparency, drive accountability, and ultimately build this most important part that we're looking for, which is trust. I would call that the most important currency in society. Indeed, as Colin rightfully said, we need to measure what truly counts. I can only conclude as well that we have been too narrow in our pursuit of what success looks like, focusing only on financial capital and ignoring the importance of social and environmental capital has not really served us well. As we argue in our book, Net Positive, indeed, business should profit from solving the world's problems, not from creating the world's problems. This also means that we need to shine a light on the right measures to drive the needed behavior, to build the needed trust, and ultimately direct the resources and capital to what truly makes a difference. We've long argued that profits as a measure of success is simply not enough. In fact, it is the wrong measure, as Colin rightfully argues. And we see more and more evidence that it not only destroys the planet and the social cohesion, but actually puts our own existence at risk. It increasingly shows that the very shareholders who might actively be driving this are actually paying a significant price for this as well. Indeed, the mindless pursuit of profits alone destroys actually the longer term value. I see profits not differently than white blood cells in our body, for example. We need white blood cells to survive, but it is also fair to say that we don't live for white blood cells alone. As Colin has long and eloquently argued in his book Prosperity, having a deeper purpose and a broader measure of success is now also beneficial for the longer term shareholders. You even have to conclude that if Milton Friedman would write his paper today, that it would look quite differently, actually. And this is increasingly backed up by facts. You look at Just Capital, who has looked at the list of companies that rank highly on purpose and on serving society, and they found that it produced 56% higher total shareholder return over a 5-year period. A recent study of Deloitte that came across my desk shows that mission-driven companies have 30% higher innovation rates, 40% higher employee retention, higher engagements, and you would agree with me that all of this ultimately translates also in better results. And yes, I believe that's also one of the reasons that the financial market itself is waking up. Probably the biggest change we have seen over the last 12, 18 months. And that's not surprising when 81% of the sustainable indexes are actually outperforming their parent benchmarks in 2020. And I think these numbers have only gotten better in 2021. It frankly is not limited to how we narrowly define current corporate success. It actually goes to the very heart of how we measure societal success. GDP is still the measure that most countries pursue. And frankly, it's equally destructive. We also talked that in our book, Net Positive. Having a sense of total economic activity is fine, but GDP is a dated measure from an era of manufacturing before the rise of many intangible values and before we actually saw the limitations of our planetary boundaries. It counts everything that actually raises spending as a good thing. You know, if you have more cancer and medical costs, if you have more damage and reconstruction after another natural disaster, if you have wars or if you have conflicts, and liquidating other forms of capital like cutting down trees, that's all measured in GDP as being positive. But it doesn't measure what really counts: the peace, the justice, the quality of education, the mental health that we're all seeking, the air quality, the protection of our natural capital that we need to survive. It measures, in the words of Robert Kennedy, everything except which makes life worthwhile. Now, according to a study of True Cost, if companies actually had to pay, for example, the natural capital resources that they use, most of these industries, especially in food, would probably not be profitable. Increasingly, we see governments trying to internalize these externalities, and we would be better off actively and proactively addressing that ourselves. The cost of food, for example, an area I know well, would be double or more than double in some places if these externalities would be fit in. Now, the good thing is that many more people are starting to look at alternative measures. We're seeing a genuine progress indicator which looks at a company's performance around economic, environmental, and social values. We're seeing the UN's Human Development Index, which looks at life expectancy, education, and income levels. We're looking at a Happy Planet Index, which makes a formula of well-being, life expectancy, reduced inequality, ecological footprint. And then obviously we're all familiar with the Gross National Happiness Index that Bhutan rightfully has started already in 1972, I believe. Now, transparency drives trust. And we certainly saw that in Unilever. When we started our Unilever Sustainable Living Plan, we put 50 measures out there. I believe that by putting these measures out there, and actually measures that were needed, even though we didn't know how to achieve them yet, not just simple measures we could get away with, but measures like zero carbon emission, zero waste in factories, 100% fair wages and human rights in your value chain. Starting to have the courage to set the measures of what society needs. Whilst not many of these measures were readily available, by pursuing these objectives, we found ways to start to measure that. Because we shared it and made it transparent. We shared the challenges as well. We created not only the higher levels of trust and became an employer brand, but we also attracted the broader partnerships that were needed to solve these stickier problems, if you want to. And ultimately, it served the shareholder well with a 300% shareholder return over a 10-year period. So for us, it is something that we would argue is absolutely vital. And more importantly, I think we've come a long way now that we can measure and link it to also shareholder value creation. We now know that a more gender diverse board, a more inclusive organization is a better performing organization. An organization that attacks the issues of climate change across its value chain, well beyond scope 1 and 2, is a more resilient and better performing organization in general, etc., etc. Now we just need to go further from these pioneers or individual companies that have taken some of these steps in the right directions. There is no question that if we want to make a true change, we need to institutionalize it. And institutionalizing is actually already happening. Many people are talking about these factors or these measures as non-material, but they are increasingly becoming material. And with technology and other AI and other things, we've been able to make them transparent as well. In a minute, you'll hear from George Serafeim. George has done an incredible work on the weighted impact accounts, where we really look at previously considered non-material factors and actually show that they rapidly become material, and that the financial market, certainly the smart part of the financial market, is already factoring that in. He will show you that if you look at a group of companies, I think he did about 3,000 companies, 15% would not be profitable if they would just have to pay the cost of their carbon emissions. That's just carbon alone. In fact, 1/3 of them, looking at carbon alone, would see their profits decline 25%. And yet we know that a carbon price is coming in, that legislation is coming in to do that. And yet so many are still unprepared. Interestingly is that if you look in that study, what was the most striking to me is if you look at an industry sector and you look at companies within an industry sector where the one group of companies is actively mitigating the negative externalities, all of them, whilst the other ones ignore them, you are already starting to see that the market is valuing companies higher that are actively starting to mitigate. In other words, these so-called non-material factors are already becoming material. I think that's one of the reasons why you see the ESG funds growing to 50 trillion about next year. I would argue all the funds should be ESG ultimately. That's why you saw in Glasgow, the Glasgow Financial Alliance for Net Zero, which is now about $130 trillion of money under management. That's half of the world's money making commitments to be net zero. That's why you see most shareholder propositions now dealing with non-financial measures. Now we need to make it consistent, comparable, focus on the right ones that count, and be able to move on and enshrine it increasingly in legislation. That's why in Glasgow, the launch that was announced of the Sustainable Standard Board is actually one of the main announcements that shouldn't go unnoticed. I think we're trying to get there. We're trying to stop that confusion. We're trying to take these thousands of flowers that are blooming from the standard setting initiatives that are out there and trying to rapidly pick them, if you want to, and put them in a beautiful bouquet. And for the companies that are not yet fully aware of it, I would say it's coming at 100 miles an hour. We see the EU non-financial reporting directives. We see the TCFD, Task Force on Climate-Related Financial Disclosure, increasingly being enshrined in legislation. We now have the Task Force for Nature-Related Financial Disclosure becoming incredibly important. The European Taxonomy increasingly setting the standards. And then obviously the Sustainable Standard Board. Europe leads in many respects, but the US, SEC, and others are also actively getting involved. And even here in the UK, from which we're talking right now, we see it increasingly being embedded into law. Now, where do you all come in? Very simply, net positive companies are actively, proactively embracing this, but they're also helping ensure that we get the right legislation and that we embed these measures of success. They actively engage on the development of these fuller measures. They consider what type of business models they need to put behind it, the longer term, purpose-driven, sustainable business models that we all need. And they're actually pioneering on how they can explain the value creation part also to the financial market. They go well beyond the minimum requirement of publishing the standards that the legislation will come up with, and they actually are creating the standards for the future as well, not only on financial, but also on the environmental and social measures that are so important to us. In other words, these are the companies that are leading the movement. These are the companies that truly measure what they treasure, which ultimately is creating a more inclusive, equitable, and sustainable world for all of us now and generations to come. Which brings me straight back to yesterday's kickoff sessions. All this requires the courage and the leadership. And it is those companies that are led by these courageous leaders, willing to set the targets that are needed versus the ones they get away with, willing to work in partnerships to solve these tougher challenges, willing to take a responsibility of that total impact in the world, all consequences intended or not. These are the type of companies, these are the type of leaders that we need more of, that will be positioning their companies very well in the future and that will be successful. The ones that continue to ignore this, I think, are already heading to the graveyard of dinosaurs. So my simple message is, not too late, become part of the movement now. Thank you very much.
Thank you, Paul.
Thank you, Paul and Colin. Appreciate you being here and for the inspiring remarks. Next up, I would like to take a moment to introduce Bruno Roche. He is the founder of Economics of Mutuality. He is the former chief economist at Mars and the head of Catalyst, which was the internal think tank of Mars, where Economics of Mutuality was started and was responding to the question, what should be the right level of profit? He's the author of 2 books, Completing Capitalism, Heal Business to Heal the World, and Putting Purpose into Practice, with the Economics of Mutuality at Oxford University Press, where he's a co-author with Colin Mayer. I'd like to welcome I'd like to welcome Bruno and George to the stage.
Very much, Amanda, and it's a great pleasure to introduce this Fireside Chat with George Serafeim. So George, actually, he's a European from Greece. He studied in Greece, right, for his undergrad, and then he moved to the UK at the London School of Economics, and he studied banking, accounting, and finance, right? I mean, you have to tell us at some stage why you chose this topic. And then he studied the US at Harvard Business School, where he passed his PhD. He's now a professor at Harvard Business School, and his research focuses actually on measuring, driving, and communicating corporate finance and social impact. He's been teaching in multiple courses, and he has actually, I think, a real passion for the future of capitalism. And we had a chance last year to have Rebecca Anderson actually in one of our forums. And I know you've been teaching with her, especially on this concept of reimagining capitalism. I think you rank in the top 10 most popular authors out of the 12,000 business authors. That's what the internet says. So congratulations. It's not easy to be a famous author in accounting. And but also I think
it is an acquired taste, Bruno.
And also I think we had a chance actually to co-author at the beginning of this year actually an interesting paper that we called Measuring Purpose, an integrated framework. So it's George, you've been one of the co-authors with Colin Mayer, Bob Eccles, and a few others. And actually I was checking just before this interview that it's been in the top 10 download list. So again, I never thought in my life that actually a paper in accounting would be so attractive. So just as a matter of introduction, this is how we'd like to introduce you. Maybe you want to say a few additional words about yourself before we deep dive into some of the questions. Some of them will be difficult, but I'm sure you will handle them very well.
Please ask the most difficult questions, because actually that makes for the most interesting conversation, Bruno. And let me say that thank you very much for having me with you. given COVID, we are virtual, but I'm looking forward to in-person conversations as well. And you covered it very well. And the only thing that I want to say is that, you know, growing up actually in Greece, one of the things that I realized is the importance of strong governance and strong accountability for our actions. And accountability only happens if we actually have good measures that allows other people around us, but also ourselves, to be accountable for the impacts that we're having and the outcomes that we're creating. Much like if you have a broken Weight Watcher and you're trying to lose weight, that is not a great accountability mechanism for you to achieve your objective of being at a healthy weight. In the same way, I realized that if we actually don't have the right measures, we actually cannot create a society through which we as managers, employees, investors, customers, policymakers are accountable for the impacts and the outcomes that we're generating. And for me, that generated a great amount of interest in the topics of measurement, analysis of information, and how analysis of information generates insights for better decision making.
Well, actually, this is you're already answering part of my first question, so it's great. So we are catching up on time, but I just would like maybe to ask you something a bit more personal. I mean, why, in the first place, as a young undergrad, did you choose accounting and finance? And to some extent, what is your personal purpose in life, and how all the work that you're doing in accounting and finance, but also most recently the work you've been doing on impact weighting accounts project, how does it actually correspond to your personal purpose, and what kind of real objective you want to achieve through this purpose? And in a sense, my question is that how do you want to incarnate it? How you want to bring it to life, and how does it resonate with yourself as a human being?
Yeah, it's a very interesting question, and actually, Bruno, you make me reflect on some of my personal choices, because sometimes, you know, like the way that life happens, you run with 100 miles an hour, or I guess 160 kilometers an hour in Europe, and you never take a step back to reflect. And I think as I reflect on some of those choices, for me, a common thread has been how we can actually create better conditions for people to have prosperity. And for me, from a personal perspective, I happen to believe that if you actually empower more and more people, and you create an environment that is an inclusive environment where people can actually participate in markets and in organizations, that is a wonderful way of creating prosperity. And throughout the years, I have seen all the kinds of barriers that people have inside organizations, but also in markets, that don't allow them to actually participate. And that made me quite interested in business fundamentally, and using business as an engine for prosperity and growth. And it also made me reflect throughout my conversations with thousands of students across the years on what really motivates people to go into business. And I think when you ask the question to people about what motivates other people to go into business, everybody will say money, just money. But actually, if you ask them, what motivates you to go into business, then it's a much more personal question. And what you hear is the ability to be creative, the ability to be innovative, the ability to create jobs, to advance myself, to learn new things, to create a really cool product that really satisfies the customers. And of course, making money as an outcome of all of those things is typically the answer. And for me, it's a very similar reaction that I'm having. And this is something that I'm describing in my forthcoming book as well, that actually there is a great love actually for the entrepreneurial activity and for business that many people have. And that is coming from creating better outcomes for other people, and through that, creating profit. So these two ideas of purpose that you're getting from satisfying customers, from creating jobs, from doing better, from learning, growth, and so forth, is tightly linked with this idea of profit as an outcome of those efforts. And that was what I was observing growing up, and that's what motivated me as well to do the work that I'm doing right now.
Well, that's very clear. And actually, what you're describing in your own words is that actually this notion of financial capital, which actually is almost in a sense the alpha and the omega of how business has been business performance has been measured, is incomplete, right? That's not the way actually most people would evaluate their own performance. So maybe I have
a good example of that, Bruno, is what I like to say is that I still haven't met somebody that says every morning that I wake up and I go to work, the thing that I think about is, how do I maximize my profit today? No, like the reality is that you wake up, you say, okay, how can I improve this product? How can I make this more efficient? How can I deal with the customers? How I can hire better people? How can we have a greater organizational culture and so forth? And as a result, be competitive, all of those things. And I think having the test of what are you thinking when you are waking up in the morning really gives you a perspective about what really drives you and what is really happening throughout the day.
But if you like, this is actually the core, the crux of the question, because essentially, maybe put differently, the question I would have is that, what is your perspective on how much value that financial accounting captures today in terms of the value that the company can create and or destroy, right? And how did this proportion evolve over the last 20, 30 years? So in other words, and we know actually, you probably will answer, it's actually not even 50%. So in a sense, what do you think from your perspective, what do we need as investors, as business leaders, as leadership team, to make actually informed decision to maximize the value that you're creating, that you're talking about?
Yeah, it's a very interesting question. So allow me to get a little bit nerdy and a little bit technical, but you will see where I'm going. So financial accounting to me is just fascinating because it's actually a really beautiful system. It has at its basis the double entry bookkeeping system of debits and credits that allows you to keep truthful, basically accounting of different transactions. And that basically feeds into a balance sheet item and of course an income statement item as well. So the balance sheet item gives you a sense of the stock of resources and obligations that you're having right now, and the income statement shows you the flow of resources from period to period. And the way that I think about it is the following. So if you think about first the stock in the balance sheet of resources and so forth, the accounting system was developed at a time where a lot of basically the competitive advantages that were given to you from a capital and a resource perspective was really financial capital, because it was much more scarce than it is now. And the other one was just physical capital, right? Machines and machinery and buildings and so forth. And the more you had of those things, usually you tended to produce more of those things, you tend to be competitive. So that was a pretty good description of your ability in the future to create those flows in terms of the income statement. And as we have moved into an economy that, if you start a business now, in most actually industries, not in all of them, but in most industries, your primary considerations would be, how do you get people that have exceptional intellectual capital, right? And they are just great at what they're doing. How do you create an organization where people share a lot of information, they can work really well together and so forth? An organization that is trusted in society by customers, people want to work there and so forth. So it has a lot of social capital from that dimension and so forth. So, and we're moving towards kind of those types of resources being really, really important right now in terms of creating those future flows in the future.
Yes.
Because fundamentally what is an asset, for example, is this expected future cash inflows that are going to be generated in terms of economic benefits. Now, if you think about it, what happens is that the accounting system, from an income statement perspective, meaning the future flows, they can still be recorded in the future as some of those resources in terms of intellectual capital and social capital and so forth are starting to pay benefits, right? But actually, they're not reflected in the stock of resources right now in the balance sheet. So you have this intertemporal challenge from an enterprise value perspective, where a lot of the resources and the capital that you're building in the form of those types of intellectual capital and social capital and human capital and so forth, they are not reflected in your stock of resources, but they might be reflected in the future in your flow of resources in the income statement. So it doesn't mean that the accounting system will never recognize those things, but the more you rely on those unrecognized sources of value, the more they will be reflected with sometimes a very long delay, right? So think about organizations such as Amazon, for example, or Tesla and so forth. Those organizations have been building those resources for a very, very long time. And it's only now, in the last few years, that we have seen them being reflected. So that's how I think about some of those resources and the time delay, and what is the financial accounting system now reflects and doesn't reflect.
Yeah, and actually what you're pointing out is that it's one of the things actually that we teach also in our course in Oxford and also with the OM, is that because economics is in the end the management of scarcities, and scarcities have changed over time, the economic system has to, of course, adjust to this level of scarcities, the management model also, and therefore the accounting system. So I think this idea is that in a sense, the financial value is less and less a good predictor in the sense of the future value of the firm is actually, I think, something that more and more people actually are getting convinced, but yet the tools to manage our business is actually lagging. So I think I very much like the idea of leading indicator and lagging indicator that you talk about. But let me change a little bit here, because also when you talk about numbers and accounting, you also talk about, in a sense, the society, the philosophy, the values that actually we want to put into an accounting. So you can tell a story with words, but you also can tell a story with numbers. And last week I was actually in the Netherlands just before the COVID started to create some problems, and I had the chance to have a conversation with Jan-Peter Balkenende, who is a former prime minister in Holland. And he said actually that nowadays the real divide is no longer between Marxism and capitalism, but it's between, he said, the two forms of capitalism, which essentially is the Anglo-Saxon version, which is about financial capitalism, and what he would call the German or the Rhenian capitalism. And that in a sense, the future of the market economy depends on the choice that we'll collectively make, whether we are going to in a sense, put a dollar value on everything, which actually is a little bit, if you like, the caricature of the Anglo-Saxon model, versus actually having a more, in a sense, sophisticated approach, and not to put necessarily a dollar value on everything. And he was quoting this quote from Oscar Wilde, who said, the cynic is a man who knows the price of everything, but the value of nothing. So I like just to hear a little bit your perspective, because you've been you mentioned you've been raised in Greece. You saw actually the importance of governance. You came up from the cradle of democracy in a sense. So the thinking of your country has inspired the world, but yet there is a kind of a philosophical divide between the Anglo-Saxon version of capitalism and, if you like, more like the maybe the Rhenian or German version of capitalism, or if you like, the social market economy. So I'd like to hear you a little bit about what do you think, how this divide play out, and in a sense, what kind of accounting system will emerge from the philosophical choice of how we see society and value creation?
Bruno, it's such an important question. So let me say a few things about that. The first one is that when we actually don't put a price on something, that is actually a judgment that we're making, that the value of something is zero, basically. So, and sometimes actually I hear those arguments that basically say, but how can you put a price on something like carbon emissions? How can you put a price on product quality and safety and so forth? And I say, but we're already putting a price right now from an accounting perspective, but just happens that that price is zero. So we're saying this is just, we don't care about it, we don't value it. And I think in organizations, when you are actually starting to value something from an accounting perspective, it just changes the amount of management attention that you're having on that specific issue. And I think if we are trying to improve outcomes for society and the environment, it becomes really important that within organizations, we put explicit attention on those important outcomes that we all care about. Now, on the topic around the variation of capitalism around the world, what I would say is that basically there are very different forms of capitalism that are manifesting. And I think the Anglo-Saxon versus the German type of capitalism is just one of them. But I want to emphasize also that even within continental Europe, you find very different versions of capitalism. So the way that capitalism is exercised in Germany is quite different from Scandinavia, which is actually quite different from France, right? And so forth. And the way that product markets, capital markets, labor markets, but also national culture shape how we think, our norms, beliefs, and values that we have is extremely, extremely important one. And of course, then you move to Asia and you find actually the Japanese version of capitalism, or what we have now in China with state-driven actually capitalism and so forth, are very, very different manifestations of an economic system. But I think as we're having variation among the different forms of capitalism, I do think at the same time, we have a very common element and platform, which for me is manifesting more and more, which is that actually people have a very deep sense through which they want to achieve a meaningful purpose through their work, and they're looking actually for meaningful organizations to achieve that purpose. And I think actually, while we do have those variations in terms of like the forms of capitalism and so forth, we actually have a very strong common element, which is impact considerations, and the impact that we're having on society and the environment is a universal, I would say, phenomenon and demand that people are having. I could see how in the future, more and more, we're going to have attention about, you know, the importance of markets versus the importance of organizations versus the importance of policies and so forth. And I think that is going to be a debate that will last forever. Yeah. But I think what is actually changing and what is actually happening around the world, and it's really, really important, is that we have a massive, I would say, amount of energy among people to create an economic system, whether that is any form of those socioeconomic systems that actually delivers better outcomes for the environment and for society. So we can actually tackle some of the big challenges that we're facing, such as, for example, the climate change challenge and so forth.
Yeah, and actually, I think it's a good problem to have in a sense, because we are moving in a sense, the questions from outside the firm, which inside the firm, because when you're touching the management account or the reporting account, you're starting to actually touch the heart of how business is being managed. So I think it's a good problem to have, but I think you're right. Behind the different philosophies or culture that exists around the world, eventually there will be a different or variation of accounting system. But I come to that in a minute, because we also know that there is a lot of activity at the moment on the regulation side. But I'd like to start maybe to go a bit deeper into the history of accounting. And I remember there was an article written by Peter Becker. Actually, he's is the head of an organization called the WBCSD. So it's a strange acronym which stands for
so many acronyms, so many
business. No, let me see. World Business Council for Stable Development. Actually, he's my next door neighbor here in Geneva, and he wrote an article actually back in 2013. He said, "Will accountants save the world?" And implicitly he said yes. But I like also to go back to the history of accounting. And when we are preparing this interview, we talked about a man called Luca Pacioli. And Luca Pacioli, I mean, I like you to, he's eventually the inventor of the double entry accounting. And he's a man actually that lived at the end of the Middle Age, the beginning of the Enlightenment. And when I speak to historians or sociologists these days, they say, well, we are maybe at a similar point in time. So that's what we are doing now will not only impact the next 20 or 30 years, but may really impact the next 500 years. So I'd like you maybe to say a few words about, because I know you have a passion for this Venetian monk, actually, who lived 500 years ago, and eventually he's the father of modern accounting. And maybe my question for you is that, do you think we are at a Luca Pacioli moment where eventually a new accounting system will have to be invented, not necessarily a double entry, but maybe a triple, quadruple entry accounting? So I'd like just to go back to history of accounting and to see to what extent accounting can really be a solution actually to drive our society to the next era of capitalism.
There are a couple of, it's fascinating topic, and there are a couple of points to make there. The first thing is that, a fun fact, Luca Pacioli was best friends with Leonardo da Vinci, which basically says that pick your friends wisely, because even if you do something extremely important, if your friend is even more well known than you, many people might not know you. Just a fun fact, but it also shows how the ecosystem, I would say, of intellectual thought leadership can really help each other. The second point to make is what Luca Pacioli did is just revolutionary, right? He went from double entry bookkeeping, which somebody would make single entries basically of every transaction, that doesn't allow you to discipline your accounting system, because there is no way of making sure that you haven't made an error. Create the double entry bookkeeping, which is a natural system through which you identify whether you have made an error or something is missing, basically, from your books. And it's a huge innovation, and of course catalyzed, in my opinion, really the ability to have large-scale organizations today. I don't think you would be able to have a Marks and Spencer or a Carrefour or a Volkswagen or a Siemens if you didn't have the basic ability to say how much inventory we have, like how much we're paying people, right? And all of those things. So I think it's extremely important. And I think, to your point, and we are at that moment, I think we are at that moment where we're recognizing that actually organizations have a tremendous amount of impact on people and planet, and we need to actually account for that. And that impact that they are having is actually increasingly becoming internalized because people want to reflect that impact when they are making employment choices, investment choice, consumption choices, and policymakers are increasingly regulating that impact. So as this is happening, we need an accounting system that reflects what is the value an organization is creating after taking into account those impacts as well. Now, I think we know the destination, but we don't necessarily know the journey, right? And I think that's okay, actually. Many people actually get uncomfortable with that, but I think that is okay because there can be many journeys to get us there. So what is the exact mechanism through which we can actually capture all those things and how we can actually reflect them in an accounting framework, in an accounting system, is a question mark right now. But the destination is clear. And I think as more and more people are working on this domain and they are not taking the perspective of well, this is just too complicated, this cannot be done, but take the perspective of how can we improve things one step at a time and keep moving forward, I think eventually we'll be able to make quite a bit of success. And this is what we have found in the Impact Weighted Accounts initiative as well. When we started, basically, we looked at that and we said, wow, like, you know, many of those things are very, very difficult. There is no data in many cases and so forth. And 2 years later, we have been able to create large-scale data sets that allows us to do research and allows us to at a much deeper level understand either the environmental impact or the employment impact or the impacts that organizations are having through their products and services. So my perspective is that basically you build an MVP and then you keep improving on that. And I think if accounting actually adopts the same type of perspective, which in many ways it has traditionally have, which is you build something and nothing is perfect, but you keep improving. So if you think about the history of pension accounting, lease accounting, revenue recognition, it is one of continuous improvement, actually. Right. It's not that 20 years ago it was perfect, it was just good enough.
Yeah, and actually it's the next, I mean, I know time is running, and I wish we had a bit like the whole day to discuss this, because in my view it's a critical topic, which actually is it's much more than just numbers and processes. It's really about the type of world we want to live in. But you see, there is a lot of activity at the moment in the regulation world, and the EU, for instance, is quite advanced actually on their objective to impose a double materiality approach to all the companies of 40 million euros, which actually means that half of the GDP of Europe will be concerned by this kind of reporting. So the EU is kind of leading the way, at least intellectually, but there are all the forms of standards, the IFRS, the ISSB, the US GAAP, and probably also Asia will come up with their own standards. So I just would like maybe to give us like the perspective of, hey, how many standards do you think eventually we will handle over the next 5 to 10 years? I know we have a sea of ESG, which actually is very confusing at best or misleading at worst. So we will probably see like a simplification of the norms driven by regulation. But I just would like to hear your perspective on these 2 points. How do you think, how many eventually standards we will have to handle with, and what type of what is your perspective on this concept of double materiality versus single materiality, and how it will impact actually the performance of business and the impact on society and the environment?
So important questions, Bruno. And what I would say about double materiality is, think about it, right? So double materiality basically says you need to actually be able to measure and disclose all the types of impacts that are material for an organization in terms of affecting its ability to create value over time. But the double materiality says that even if it's not something that is material for affecting the organization, but it's actually materially affecting the environment and society, you need to measure and be able to report on that. And that is the concept of really double materiality. And for me, actually, if you take a step back and say, what is success? When we would be able to get into an economic system and a resource allocation system that would be successful? I think the success would be when those two versions of materiality have converged.
Right.
And we are actually having an economic system where the impacts that you're having on people and on the environment are actually financially material impacts, right? And I think if you think about it as a journey, the way that I describe it is that we're on the path towards there. I think, I don't know if we're 20% there, 40% there, 30%, who knows, right? Sometimes there is also false sense of accuracy sometimes. But what I do know is that we're not at 100 and we're not at 0, right? And I think we were at 0. There was a time actually that we're at 0. But I think especially in the last 20 years, many of those impacts are becoming more and more financially impactful, strategically relevant, and as a result, also financially material. So how the real question is, how can we keep traveling the journey? what are the institutions that we need to create from a policy perspective, from a markets perspective, about how we can empower customers to make choices, how we can empower employees to make choices, how we can empower investors to make choices, in order for those definitions of materiality to fully converge. Because that would be a huge, I think, success, right? And I say that also, Bruno, because it is important to recognize, working with many organizations, sitting on the board of many organizations as well. And what I say is that if an organization is doing something that actually is not profitable at the end of the day, it is actually not sustainable, and it's not scalable either, because it's a very dynamic competitive environment, and it's that much that you can do if those two definitions don't converge. So our emphasis should be on creating the institutions, including the accounting institutions, that allow those things to converge over time. And I think that is very, very important.
Yeah, maybe as a last word, you see, when we started our journey 15 years ago, the question was, what should be the right level of profit? Okay, and at that time, there was almost no research done on this topic in management and economic literature. Today, we see a body of literature, and actually the work you're doing is, in my view, critical on that path, but long is a journey. So just as a last word, I know we have short in time, but last year we had 40,000 people who viewed the forum, right? Maybe this year we have achieved like 50 or 60,000, hopefully. So you may have actually a chance to, and before you have virtually students, researchers, policymakers, business leaders. So if there is like one thing that you would like to plant a seed in their mind, what would it be?
I think the idea that actually perfection is the enemy of progress many times is that we're dealing with some really difficult issues, especially as it relates to measurement and accounting. And I think not letting that stop us from making progress, and that this is a critical piece of the institutional infrastructure that we need to build, that we need to be able to measure the environmental and social impacts and outcomes that organizations are having if we want to change behavior, because then we need to create the incentives for organizations to change behavior, is a really, really critical piece. And especially for the students, if somebody tells them that something cannot be done and it's impossible, it's exactly what they should be devoting their efforts to be doing, because proving people wrong is one of the best things.
George, thank you very much for your time and for all of this insight. And I personally wish you really a lot of success in your research. And my calling is that we need more people like you who are embracing this dry and difficult topic, but which is critical for the future of the market economy. Thank you again.
Thank you, Bruno, for having me.
Thank you so much to Bruno and George. We are going to get started with our next part of the forum, which is going to be a panel discussion on the future of performance management. And as our panelists take the stage, I want to take a moment to introduce our moderator, Judith Stroehle. Judith is a senior research fellow at the Saïd Business School in Oxford and the program lead of the Oxford Rethinking Performance Institute. Her research is focused on how tools of finance, accounting, and reporting can help to implement responsible business. Most recently, she's exploring issues related to the measurement of corporate purpose, including the benefits and challenge of non-financial metrics and accounting, as well as ESG strategies. Those relationships between diverse sets of frameworks, standards, and methods. She works with nonprofits, companies, and asset managers on their non-financial strategies, reporting, and management practices. And she is a Global Future Council Fellow for SDG Investing with the World Economic Forum, as well as a member of the Prosper for All Steering Group for the Spanish Foundation. Code SPA. Welcome, Judith.
Thank you very much. And good morning, good day, good afternoon from wherever you're joining us. I think this will be a tremendous panel. It's already been a tremendous morning. I really enjoyed listening to Bruno and George just now in what was, I think, a very good impetus for the conversation that we will be having just following. So the future of performance measurement is obviously all the rage. It's a tremendously important topic, and it is at the core of the current discussion. I love that Bruno just mentioned the article from Peter Bakker, who was written almost 10 years ago, that accountants will save the world. And you can agree with that statement or you cannot agree with it, but there is certainly a sense that measurement and the accuracy that we expect from accountants and auditors is increasingly seen as the key as we race against time in an economy that is net zero, that is diverse, equal, and inclusive. With COP26 fresh in our minds, we do need to ask, how do we actually hold to account all of the high-level pledges for net zero, purpose in relation to SDGs that have been made? High-level pledges are important. They're very often well-intended, but unfortunately, they're also often quite empty. And so getting to a system of where we can actually account for all of these goals and targets will be really, really important. A lot of work is going on. We've just heard from the important work at Harvard Business School around the Harvard Impact Weighted Accounts Initiative. And also the economics of mutuality has worked on a mutual P&L, a mutual profit and loss statement, which adjusts financial profit through maintenance of costs and hypothetical replenishment costs. So there's a lot of really interesting methodological work going on, thinking about how can we actually arrive at a notion of profit that is more true and more just in relation to corporate purpose, long-term economic value creation, and sustainable development. Now, rethinking performance in relation to corporate purpose is at the core of all of this and what we want to discuss. For it, we need meaningful, comparable, assured measures, and there's obviously quite a lot of roadblocks to this still. To discuss all of this, we have two absolutely fabulous speakers today, and I'm very, very pleased to welcome them with me. We have Nadine Mottu with us, who is a senior private banker and head of international family businesses at the Lombard Odier Group, which is one of the oldest Swiss private banks. She's been there for over 20 years, so brings a wealth of experience with her. Nadine is leading efforts to integrate ESG at the portfolio level and always thinking about sort of the long-term value creation for her clients, exactly what we want to speak about. And she's a chartered financial analyst by training and board member of various foundations, so brings that side of the experience as well. Welcome, Nadine, and we look forward to hearing from you. Our second speaker is Veronica, and Veronica is Vice Chair of Deloitte UK, Global IFRS and Corporate Reporting Leader, and the NSE Head of Accounting and Corporate Reporting. She's led Deloitte's contributions to the WEF IBC stakeholder capitalism metrics and has facilitated the work of the leading sustainability standard setters to develop prototype climate standards. She helped launch the UK Directors Climate Forum Chapter 0, spearheaded Deloitte's partnership with the IFRS Finance for the Future Awards, and is a member of the FRC panel and the BASE external stakeholder group. List goes on. Veronica is obviously a force of nature, as you can see, and she has been recognized as such through the Accountant of the Year in 2020 in the Women in Finance Award, and it's an absolute pleasure to have you here. I'll ask both of our speakers to make an opening statement of 5 to 7 minutes, and we'll then go into discussion. I hope we'll still have time for Q&A, so please do pop questions into the box if you have them, and we will go from there. Nadine, I'd love to start with you, please. The floor is yours.
Well, thank you very much. Good morning to everybody. Well, let's start by a short description. As a banker at Lombard Odier, responsible for international families, our mission is really to preserve and to grow the assets of our client, and that's thanks to performance mainly. But we strongly think also that the best way to generate today solid and long-term performance is through a sustainable investing. We also think that today the model of a take, make, and waste system has to change. And that's why we think we are really in an important transformation driven by, you have the changing consumer demand, but you have also the demand of the investors who are changing. You have a new and a cheaper technology, and you have the regulatory and the government pressure. So all this is really leading to quite some important changes. And at Lombard, we really think that the sustainability trend is inevitable, and it's even at our client interest that they are best served by promoting this sustainable finance. So we really think it's our responsibility, to help them to invest in this transition. We have even developed a specific economic model that we call the click economy. Click for a circular, lean, inclusive, and cleaner economy, as opposite to the older economy, let's say, which is more take, waste, and make economy. But in order to implement all these changes, I would say we need two very important things. One is a very strong commitment of the top management of every company, and in this case, for example, the top management of Lombard. And the second very important pillar, I would say, to implement this new strategy, we have to hire and to develop also new expertise. Directly, this expertise should depend directly from the top management. So I'm talking about academic partnership, I'm talking about scientific joining a bank. So we really have to develop this kind of new expertise. Maybe at Lombard, just a few words about our history. For us, it's, I would say, already quite some time that we are really thinking about sustainability. For example, in 1997, we have introduced the first ESG scoring. So I would say nothing new, but something which has to be adapted over the time. In 2019, we were one of the first banks being B Corp certificate. We have also one of the first partnership with what we call affirmative management for global climate bonds. So in 2017, we were already launching some green bonds, sustainable bonds, with, again, collaboration with some other companies. Since a few years, we try now to align the portfolio to some very sustainable topics, and that I would be happy to give you more details. We are founding member, for example, of the Natural Cap Alliance, or on the Sustainability Research, a partnership with Oxford University. So I would say very active since quite some time. But let me just give you one example in terms of top management. We have our two main senior partners. Mr. Hubert Keller was actively taking part of the COP26, and Mr. Patrick Odier, he is really a very strong ambassador. So, for example, he was part of the Building Sustainability Week with the Oxford University, and he is now leading the Building Bridge Summit in the coming days. So we strongly think that there is an implication of the financial capital world in order to redeploy some of the capital in this greener world. We strongly believe that, capital will encourage the right direction to be taken by industries, in the sense that I think this time banking can even be part of the solution, trying to support this trend. In Switzerland, in particular, we have quite a unique ecosystem, which we can try, let's say, to breach the sustainable goals of the United Nations and the 17 goals with the world of finance. And that's one of the reasons, for example, Mr. Patrick Odier is now leading this second Building Bridges Summit. So the aim here is not to attract only the finance industry, but all those who want to contribute to this kind of dialogue, with an ultimately lead to the acceleration of the sustainability transition. So when we're thinking about dialogue, we are thinking particularly about NGOs, industries, and the financial sector. So everybody has to work together in order to accelerate this transition to a sustainable world. For the financial world, what we strongly believe is we need three main factors. One is a common language. All the financial industry has to start to talk the common language. The second point is the availability of the data. We need to have a strong availability. And finally, it's the regulatory framework that really will create this incentive for global capital to flow into this transition. So that would be, in a few words, let's say, my introduction and what we are trying to do at Lombard.
Thank you very much, Nadine. Some really good insights from finance and sort of an operational perspective. I really like your point around partnerships and that there needs to be a dialogue, this notion around new expertise that is needed, all really, really important insights. Veronica, can I ask you next, please, to make your opening statement?
Thank you, Judith. And I very much welcome your focus today on the future of performance management. If we are truly to put purpose and stakeholder focus at the heart of business, we do need to ensure it is accompanied by transparency and accountability. And as a result, we are now seeing a push for reporting standards and more rigorous scrutiny of the private sector actions in the light of all those commitments and claims that companies are making on climate and their contribution to the Sustainable Development Goals. As you will be aware, the IFRS Foundation trustees announced a new International Sustainability Standards Board at COP26. And along with this, they announced a commitment to consolidate leading sustainability standard setters into that new board. They also released 2 prototype standards. So quite a lot happened there. And this is, in fact, a huge leap for corporate reporting. IFRS standards have enabled us to have essential financial information at our fingertips. And we're now making that essential, similar first step for sustainability information. So very exciting. And the reason why I'm so excited about it, it's because I think global sustainability standards will facilitate consistent and comparable reporting by companies across jurisdictions. They will deliver that language that Nadine was just talking about. This will help us direct capital to long-term resilient business as the world transitions to a low-carbon economy. Now, the commitment of by CTSB and the Value Reporting Foundation that comprises, of course, SASB standards and integrated reporting to great authorities in the sustainability world, to merge with the new board sends the clearest signal yet that the ISSB is really emerging as that global sustainability standard setter. This should reduce fragmentation and confusion in the sustainability standard setting landscape that Bruno was talking about in his remarks just before we started. Now, to give a running start to the new board, the IFRS Foundation set up a technical readiness working group, TRWG, and it comprised organizations that focus on ESG reporting relevant to enterprise value. I have been honored personally to have represented the World Economic Forum in that technical work. Now, why is TRWG important? Well, it has done quite a lot of work and has passed on a huge amount of important thinking to the new board. And this does include recommendations on the overall architecture of standards, conceptual guidelines, prototype standards for general disclosure and on climate, recommendations on connectivity, digitization, due process. And one other important thing that they have delivered is this proposal for an agenda consultation. So we do know that while the standard on climate, of course, is proposed to be the first thematic standard, and that does reflect the urgency of addressing climate change, the ISSB will be moving very quickly to other ESG topics, including urgent societal issues that need to be addressed, such as diversity, equity and inclusion, work practices, health and safety. So the architecture of the standards going forward will comprise of 3 key elements: a general disclosure requirement standard that will set out the key concepts like the reporting channel, frequency of reporting, the materiality lens, the reporting boundaries, the expected attributes of information, thematic standards that will address pervasive sustainability-related topics such as climate, human capital, other topics common across business, and of course, industry-specific standards. So from day one, companies will be expected already to report on all material sustainability matters, covering the aspects of governance, strategy, risk management, and metrics and targets. And importantly, they will report this information in the mainstream. This means in their annual reports and for the same reporting period as their financial statements at that same time. So climate prototype is an example of a thematic standards and does reflect TCFD recommendations, and of course does involve including cross-industry metrics in your reporting like scope 1, 2, and 3 greenhouse gas emissions, and of course industry-specific metrics that will be derived from the SASB standards. So quite a lot happening there. But what do we expect next and by when? Well, first of all, we would expect, of course, appointments to the board, the chairs, the vice chairs, the board members. And then in terms of timing of the standards, it is clear from IOSCO that they are expecting to be in a position to endorse the first set of initial ISSB standards by the end of next year. So working back from there, watch out. January, February, we will be seeing exposure drafts and the final standards in Q2, Q3. So companies will need to be getting ready, and they will need to bring that sustainability reporting into their everyday vocabulary and the skill set. But furthermore, and I think Nadine picked up on that, to be authentic and credible, that reporting will need to reflect what is actually happening in the business. And this means integrating sustainability into the core of the business, or in other words, applying that integrated thinking. So we need organizational change, we need business model transformation, we need cultural shift, we need new KPIs to codify all these new organizational important matters, and we need to foster organizational transparency and accountability. So we need to do a lot, we need to do it very quickly, and the accounting standards that we're going to get for sustainability, of course, are there to make a huge difference. So let me stop here. There is a lot happening here, a lot to discuss.
Yeah, wonderful. And they're very exciting developments. I think I always joke with my students when I say I never thought that I would find regulation exciting, but what is happening currently is actually very, very exciting and very ambitious in terms of the timeline that you just outlined. So we will definitely come back to that. I do want to start talking a little bit about the piece around measurement methodology and some of the implementation that you just talked about, Veronica. And Nadine, why don't we start with you? You at Lombard Odier have a really long history of ESG integration, as you already mentioned. You actively engage with companies, and you sort of have the certified, the B Corp certification, which brings with itself certain measurements and KPIs of non-financial importance. But can you tell us a little bit more about how you measure performance holistically at Lombard Odier? So how do you implement this into your day-to-day decisions at your organization at the portfolio level?
Okay, with pleasure. Thank you very much. So as you are mentioning, it's really on a daily basis. I think you have to monitor it on a daily basis, and you have to try to improve different ratings on a daily basis. Let me just start that we have three main pillars on our investment strategy. And the first pillar, let's say the normal pillar, it's really sustainable financial model. So here we continue to analyze company on a financial model, the P&L, the balance sheet, really the classical figures, because we still want a very profitable company and with low debt, really the standard. So there is nothing changed on the first pillar. What we have added two more pillars. So the second pillar, it's more what we call sustainable business practice. And the third pillar would be a sustainable business model. So we have a sustainable financial model, it's the first pillar. The second pillar is a sustainable business practice, and the third is a sustainable business model. So if I talk a little bit more about the sustainable business practice, it's here where we have started with ESG, but not only ESG, you will see. It's also regarding the Sustainable Development Goals of the 17 Sustainable Goals that we try to compare to the portfolio. So if I start with ESG, we have now a state-of-the-art IT tools, which is more or less tailor-made inside our bank, which really enables us to analyze not only the company, the ESG rating of each company, we can even go through all the funds which are deposited with the bank, so really in-depth into transparency, and to analyze company by company, fund by fund, the ESG rating. Then what's important is to compare it to a benchmark. Once you have a rating of all these kind of companies, you need a kind of benchmark. Where do we stay against the average? And then it's the way to improve it. So, for example, here at Lombard Odier, we have a rating on a daily basis. You can really measure the rating on a daily basis of your portfolio. You can do an in-depth analysis to have the top 5, but the top worst performer, to try to identify which are the best in class, which are the worst in class. But this is, I would say, just the first step. Sorry. The second step is you can also add some exclusion, depending, talking with our customers. Some people would like to really have some exclusion. They maybe have some sectors that you just don't want to be invested in. But again, it depends a little bit more on our customers. We have an ASG rating for all kind of sectors. So we can carefully monitor all kind of exclusion that you would like to set up. So that's really on the how a little bit, how put into place the sustainability. And then what we add is what we call a sustainable business model. And that's here where we have created our click strategy in really to analyze a little bit what are the company doing. So what do I mean by this click sustainable framework? We want to focus on more circularity between our companies. So again, it's some United Nations Sustainable Development Goals, but it's really focused on, for example, zero waste. It is focused on a circular economy, on regenerative nature. So trying to identify some companies very active in this field. The second point is lean. Try to be a little bit more leaner, to use the resource more efficiency. And here again, we have to identify the right companies. The third one, trying to be more inclusive. So that's also either you try to find some companies which are acting to a more fairer society, a more secure security, or what you try to do is do it yourself also. We also try to do, for example, when we are launching some structured notes today, we may share some of the profit share the profit and then invest in a sustainable investment, helping a local ONG, for example. So you can work all together with your client and say, this kind of structured note that we are now issuing today, we suggest to share the profits. We will take a little bit less fees. You will charge maybe a little bit of your fees, and we will spend some of the amount to support a local ONG. So there you can, I would say there's a lot of thinking how to be a little bit more inclusive. And the last point is to have a cleaner economy. And here again, we have to identify quite a lot of companies. You have talked a lot about the zero emission target to adjust to the environmental changes. So we clearly think that you have the ESG, you have the accounting, but you have also a new way to analyzing a sustainable framework, but more circular, more leaner, more inclusive, and a more cleaner economy, and trying to identify the actors in this field. It is something which is, I would say, changing quite a lot. We have now quite an important team. We have to do it, it's a teamwork, not only inside the bank, but it's also a partnership outside the bank. The ESG rating, we are talking about more than 22,000 companies which are analyzed, and with an external tools working together with the bank. So I think it's quite a powerful tool that we are implementing since some time. And what I have to say, I really realized that there are more and more clients which are very interested to improve their portfolio. And we need the support. The bank can have a tool at disposal, but we need also the support of our customer. And it's quite interesting to see that the people who are really interested in sustainable development, they don't want to do it just for part of the portfolio. Let's do 10% of my portfolio. Now, if you strongly believe in sustainability, you want to do it on the total portfolio. You want to do it for all kinds of equities, but you want also to do it for all kinds of asset classes. And that will be maybe one of the challenges in the future. But what we are trying to do, it's not only on the equities, but you can implement the same ESG rating on the bonds. And then you can, like I mentioned before, on the structured note, you can be a little bit more inclusive. The challenge is on the hedge fund, but we are working hard, starting to have some answer also. And then you have also on the private assets. Here also, you start to have some impact funds, some private equity impact funds. So you can really work all kinds of asset classes. And I think it's a challenging environment, but very interesting, and with a lot of investment opportunities, because there are a lot of companies which are now following this new trend, very profitable. And so we strongly believe that the performance is there.
Brilliant. Thank you very much, Nadine. I think it's really, really interesting insights. And I think particular point around the different asset classes, that this is something that's, we're possible to implement not only in the public equity, which seems to be sort of very often perceived that way, is very important. Also really interesting to hear that your clients are driving this, right? Really showing that there's this strong stakeholder interest now from various directions. Veronica, I'd like to move to you and again talk a little bit more about sort of these methodological frameworks that are out there. Now, you've spoken about the standard for reporting, but we've heard in the session before that very often organizations now also make use of monetization, impact valuation, these kinds of methodologies that are out there. They seem to be growing because there seems to be real need for more information, different types of information for decision making. Can you give us a little bit of your judgment around these systems of monetization and when organizations could use them, whether you find them useful or not?
Thanks, Judith. Well, first of all, I think we should say that we must welcome innovation in measurement methodologies. Monetization is clearly a step we could take in the evolution of the broader corporate reporting system. And we have some great examples of innovation in that space already. You already referenced the economics of mutuality, impact-weighted accounts, but of course there is also Value Balancing Alliance and quite a few others. But I think before we take this step, we need to recognize that in order to make the case for monetization, we need to actually prove that it can significantly lead to a better outcome than what we can achieve with comparable and consistent reporting of the underlying metrics, which could be used in the analytical tools and can support forecasting and NPV calculations, the stuff that Nadine was talking about just now. Now, furthermore, before we can monetize in a systemic way, we need to agree how to measure and report the underlying metrics, such as GHG emissions, to a consistent and comparable quality. Now, with the ISSB standards, of course, we can achieve this through the global baseline of sustainability information that is relevant to enterprise value. But George talked about this before, and I would emphasize that we need consistent, comparable application of the standards across all jurisdictions. And then we need to consider, what are the impacts that we are not measuring under the ISSB standards? Are there metrics in companies on broader impacts that we want to capture, but that do not affect enterprise value? Now, consistency in this area will be challenging because these broader impacts generally reflect public policy priorities, and that by their nature tends to be very variable across jurisdictions. And in fact, we couldn't agree as to how we approach some of these public policy priorities across the world. If we think around the way we approach some of the social issues in China versus UK or US. In addition, we will need to agree how to price or value some of the sustainability impacts in a consistent way. So carbon pricing is one example where you can see that agreement could be reached. And we made already some progress on this during COP26. But how would we go about pricing other sustainability issues like human rights, child labor, biodiversity? And as we have seen with carbon pricing, this is not a simple ask, even in the case of something that is really akin to a commodity. Now, for intangibles like social and systemic issues, this will require significant consideration and building that international consensus to put a value on any of these things. So having said all of that, of course, putting a monetary value on externalities can indeed support decision-making. And as we already know, it can be a very useful management accounting technique, particularly in assessing the trade-offs, very important trade-offs that companies make between various sustainability issues. And therefore, it can be a very important component of an integrated thinking. So we need to innovate. We need to take that next step. And like George, I would encourage the academic world to make that step, to research that further, to build a consensus, to help us build a consensus in that area. But remembering that measurement is not a silver bullet, and we will still need other policy interventions to address planetary limits and the role of corporates in society.
Brilliant. Thank you very much, Veronica. Let me just follow up on what you just said. And I think this also ties in with a few questions that have come in regarding sort of the standardization and regulation piece. So I think listeners are really interested to hear more about how the work of the ISSB will tie in with existing regulation, particularly EU taxonomy, but also the Corporate Sustainability Reporting Directive that will be coming up at the European level. And then how that will work with the local implementation of the ISSB, which will also have to come from the regulator. So perhaps you can give us a few ideas about this.
Yeah, sure. Well, as I already said, with sustainability standards, we are making the first very important step towards consistent and comparable sustainability information. And I will sound like a broken record, but we do need now to achieve that consistent worldwide adoption of these standards, but recognize that different jurisdictions around the world will have their own specific needs and their own specific expectations. So the solution that is often discussed is building blocks approach. Well, under this model, we should take the ISSB standards as the first block across all jurisdictions to create a consistent global baseline of reporting requirements. And these are the reporting requirements focused on the needs of investors and capital markets. And this is what we do today across 144 jurisdictions for financial reporting with IFRS. Now, further blocks, of course, may be introduced for additional reporting requirements to meet policy priorities at jurisdiction level. So block 2 could meet the specific needs of a taxonomy in a jurisdiction if they're not already captured by the first block, by enterprise value relevant metrics. Now, in this regard, it is actually pleasing to see that finance ministers and central bank governors from 40 jurisdictions, and that does include China, the European Commission, the UK, the US, they have already publicly welcomed the ISSB and its work program to develop this global baseline of sustainability standards focused on enterprise value. Now, Europe is often cited as presenting a particular challenge because of the well-established legal concept of double materiality. And Bruno asked a very pointed question at George earlier about double versus single materiality. But let me do my take on this, on the double materiality versus single. Well, double materiality, as defined in the NFRD and now in the CSRD, specifies that companies should report on both the inside-out perspective and the outside-in perspective. It then explains that companies should consider each materiality perspective in its own right and should disclose information that is material from both perspectives, as well as information that is material from only one perspective. Well, I personally do not see this as a particularly helpful or clear way of thinking about materiality, because companies will need to look at each dimension separately without actually recognizing that a company's external impacts, in fact, many of companies' external impacts can and do affect enterprise value. So on that scale that George was talking about, from 0 to 100, we are on the journey. A lot of these impacts are enterprise value relevance. And in other words, enterprise value relevant impacts are a subset of all impacts that a company makes on people, planet, and the economy. And that's how the group of 5 of the leading sustainability standard setters viewed this. They referred to this as nested and dynamic materiality. So it would be clearer, in my view, to identify impacts that are enterprise value relevant in the first instance, and then provide additional information on broader impacts that are not covered by that first block of thinking. And so here we must also, of course, recognize that on that journey that George again was describing from 0 to 100, we have made some significant step already. I think we now recognize that enterprise value materiality lens is actually very wide, especially when impacts are considered over the longer term. So in fact, enterprise value materiality should cover most impacts, in my view. So it's very difficult to envisage what would not be covered on issues such as climate change, water, or diversity and inclusion. We are very much aligning, I think, the needs of business, the business license to operate, the role of business in the society, with the thinking more holistically about people, planet, and economy. So I think we should stop fixating on single versus double, and instead we should look at what the enterprise value approach doesn't cover, identify those issues and metrics, and create additional blocks of information where necessary to meet specific needs. And Europe can, and in my view, should take this approach to enable a consistent baseline of enterprise value relevant sustainability information to be created for capital markets, but then add to meet its own policy objectives. Hope that kind of gives you a bit of a perspective on how I think about it.
Absolutely. No, that's been very, very helpful. And in a very complex environment, I think it really puts into context how the different things fit together. I really like that you always bring us back to the notion of enterprise value, and which really neatly actually connects to what Nadine said before around focusing on business practice and business models, right? It's not just about this overall thinking of impact, but really how it connects to commercially viable solutions, and what George said, that are actually scalable in the long term. Nadine, can I just turn to you again and perhaps pick up on this conversation around standards and regulations? And I'll link this in with a few questions that have come in as well. I'd be really keen to understand whether this international standardization that we are now walking towards, whether that will make a difference for your attempts to implement ESG and to practice sustainable finance. And there's a few questions. Wim asked whether greenwashing is ever a concern. So perhaps the question is, these types of standards, can they alleviate greenwashing concerns? Dan was asking, how do we standardize ESG measures, right? There's perhaps a question around, can these standardizations in the reporting space also help us standardize ESG? So perhaps just an overall interest in what does standardization mean for the integration of ESG at a bank like Lombard Odier?
Okay, quite a different questions, but with pleasure. I would say regarding ESG standards, I liked also what Veronica said. We are also in a world which is moving, where we need some innovation, which we need quite a lot of updates. So really this ESG rating, it's moving quite a lot. What's quite important is to have an independent ESG rating company. So, it's not Lombard Odier, which is doing his own ESG rating, but we are working with an external company, which is doing this since many, many years. And it's not a static way to analyze a company. It's also rather dynamic. So it means, first, it's a lot of questions that have to be asked to the company, but then you have a kind of double check of some other external information. So in order to define these environmental, social, and government notes, it's not only the feedback of the company, but this independent company which are rating the companies are also using some external information. So it's not only the information what the company is giving, it's also you can have access to quite external information. That's the first point. The second point where we're looking also quite a lot, it's on a dynamic point of view. So you have the ESG rating today, and then you have what do they plan to do in the future in order to improve the ESG rating, and what they have done over the last 1, 2, or 3 years. So you have another more dynamic metrics inside the ESG. But that's also the reason why, as I said before, it's not the only way to value sustainability. So for us, one thing it's very important, it should be on the DNA of the company. So for example, we are B Corp certified, but it should really be something part of the DNA of the company at all levels, like I mentioned before, at the top management level, at the portfolio management level, but I would say everywhere. It's also about returns, and that's I have heard many times. You need returns, you need strong performance. And what's quite interesting, as of today, we can start to demonstrate that the portfolio with a strong ESG rating is performing at least as good as a portfolio without taking care about ESG rating. And that's also quite key, let's say, at the end for our clients. You should be able to manage a sizable return. And there, I really think that strong commitment to sustainability, it's even an investment opportunity. But it's also maybe one of our challenge is to identify all these transition. You have a lot of companies which are in a transition phase. So you may even have a car company, you know, which today doesn't seem very sustainable, but maybe they're in a transition phase and maybe looking forward, sorry, at the end, it can end to be a very sustainable company. So we have to be very dynamic and forward-looking and analyzing all kinds of sectors. And it is right that the ESG model or framework is changing quite a lot. It is improving. So that's why it's very important to have access to this data. That's why also now we have better technology, cheaper technology. I think it's more accessible to many other financial institutions. And it's quite important that we are using more and more the same framework. And there we are quite happy to even share our IT tools, for example. That's something also that we may share with other institutions. We may share the reporting. Like you said, I think it's also very important to have a good reporting, to know where you are, to know where you want to go. And finally, why it takes some time, it's also you have to change a little bit the kind of people that you are hiring inside the bank, trying to understand this kind of ESG reporting, trying to challenge them also. But I think we have seen quite a lot of improvement in this field so far.
Thank you very much. No, that's really helpful, and it sort of brings it down to the implementation level again. So we have 5 minutes left, and I just want to sort of highlight a few of the perhaps challenges that still exist. We've already spoke about a few. And to not end on a depressing note, let's also talk about some of the solutions that we have for these challenges. So Nadine, can I just invite you to sort of highlight some challenges that you still see in the space and how Lombard Odier is dealing with them?
Well, okay, I would say the problem is not the lack of capital, but the problem is really the way we deploy this capital. If you take the financial industry, we are talking about a huge amount of assets. If I take the private and the public industry, we are talking more or less about 120 trillions of assets, which is deployed in the financial world. So the challenge is really trying to deploy a little bit more of the capital to some sustainable issues and really to identify them. For example, we have identified two very important issues where we would like to drive a little bit more the capital. The first one is natural capital, biodiversity. Do you know that today, for example, 50% of the global GDP worldwide is relying directly or indirectly to the nature? And if you continue to destroy this nature, you are destroying the most productive assets of your economy. And that's kind of language that maybe most investors can also understand. And that's why we try, for example, to align our portfolio on some thematic investment. For example, here it's natural capital. Try to identify some companies which are really focusing in these kind of sectors. And it's quite interesting because the challenge that we have today, you need a good performance. And so far, you need also to be on the right cycle. And the cycle is here at the moment. The performance is there. So that's, I would say, it's quite interesting because you need to have profitable companies. You need to generate sizable performance. But we think that there is an opportunity in what we call this bio-circular economy that we are happy to implement for our client. The second opportunity, and it's also a challenge, is the growth of the carbon market. So you know that's also a challenge which has been mentioned many times with the COP26. So it's really driven by this net zero commitment that so many companies are making. Now the challenge is to identify the companies and to try to invest and to support this kind of companies. So there are quite a lot of direct fundings that could be now a little bit more directed in this kind of companies. And here again, we have to set up the right vehicle, the right way to support these companies. But I would say, last but not least, one of the challenges that we have is also the time. We really think that here and we have now a window of opportunity to reverse some of the damage caused by the nature, but this window of opportunity is closing rather fast. So I think we have really to work hard and fast.
Wonderful. Thank you very much. I think it's a very, very good framing of this risk and opportunity, and always having these two sides in mind when we speak about this topic. Excellent. We only have, I think, 2 minutes left, but I do want to use those to give Veronica the last word. Veronica, perhaps just an interest. I mean, you're sort of the queen of standardization in my mind, and so I'd just be interested in, when we look at reporting and measurement, and you've said time and again it's really important to not just measure. It's not a silver bullet. It needs to be integrated thinking, and there needs to be a good business model and forward-looking economic value creation. How do we ensure that measurement is not just a tick box exercise, but that it actually is a function of integrated thinking?
Thanks, Judith. And yes, queen of standardization is not something I've been called before, but hey ho. Anyway, reporting, in my view, is a means to an end. And as you rightly say, it is really needing to communicate what is actually happening within the business. It needs to be authentic, credible. It needs to ideally reflect that integrated thinking about sustainability issues. And integration means integrations into the DNA, into the core of the business. It does mean applying that integrated thinking in your decisions, day in, day out, taking that holistic view of the factors that can create or erode value. And that, of course, involves strengthening the governance and controls over sustainability information. And as we know, the vast majority of the value of a company today is sitting in those intangibles like people, reputation, technology. So enhancing governance over those issues would help set the right tone for behavior change and for pushing companies to embed consideration of planet, society into the core of their business. So for me, an important part of the system change, a real bonus, if you wish here, is the fact that standardization and better reporting should enhance this behavioral change. But to accompany it, we absolutely must bring in a mechanism to clarify direct responsibilities for this broader sustainability information included in their reporting. And we should make sure that the boards consider enhancements to their governance and controls over this information. That, I think, combination between reporting and a better emphasis on direct responsibilities around those broader issues will absolutely bring a behavioral change we're all looking for.
Wonderful. Thank you very much, Veronica. And this links in just perfectly with what we heard yesterday about leadership and the importance of the board and purpose in guiding organizations. So thank you very much, Veronica. Thank you very much, Nadine. It's been a pleasure having you, and your insights have been invaluable.
Thank you.
Indeed, an incredibly insightful panel. So many exciting things taking place in the sector. Thank you, ladies. Next up, it is my pleasure to introduce Lakshmi. Lakshmi is a data analyst from Teach for India, an SBS MBA candidate, and an Oxford Intesa Sanapolo scholar. She is a software engineer and a data analyst by education, and has experience in responsibly downsizing a family business, as well as teaching in suburban India. She moved to the world of impact with Teach for India, where she managed monitoring and evaluation on the fellowship selection team over the last 3 years, hence her interest in today's topic of performance management and systems change. Welcome, Lakshmi.
Thank you, Amanda. And the University of Oxford and the Economics of Mutuality Forum for this opportunity. We're here today less than a month from COP26. It has been inspiring to hear from leaders all over the world over the past 2 days. And we've seen, like, time and again, that we've moved far away from just individual performance measurements and actually going towards not even corporate performance measurements, but also measuring ourselves as a humanity. We have metrics from GDP to carbon emissions to measure ourselves, not only for profits, but also for purpose. At this point, as we look to the future, I would like to talk about what I think are some shortcomings of our current approach to incorporating performance measurement, even in its most purposeful form. I believe that we currently wait for impact and purpose measurements to make a business or a profit use case before we take them seriously. So over the next 10 minutes, I'm going to make the case that it's about time that we move beyond such extrinsic motivators and measures of performance and move towards intrinsic rewards and mechanisms to listen to systems and leaders at all levels more closely. Later in the talk, I'm going to refer to some data points from the Donut Economics Action Lab report that was recently released, and I will share some observations from my personal story, which have led me to believe that metrics and numbers without an allied culture and conviction can do very little. But to start us off, I want to begin with a thought experiment. Let's say it is the year 2015, and I come to you with two investment opportunities. The first one is a Swedish fintech unicorn that was founded in 2005. It has had a lot of success in a lot of European countries, and they're trying to enter the US market. I might even say that being a credit product, they increase financial access to a lot of people. So they are working towards the Sustainable Development Goal number 10 in a sense. There is some concern that they may be leading to consumer debt, but for the large part, they are a purposeful brand. And the second one is a group of vaccinology experts in the University of Oxford who are working towards an unknown disease X. Clearly, they're working towards SDG 3, good health and well-being, and they're specifically working towards target 3B. But at this point in time, they don't know what exactly disease X is, when it may hit us, or how many people it may affect. Which would you invest in? Which of these do you think most investors, even the most purpose-driven investors, would invest in? Of course, it's not a zero-sum game, and you may actually identify the case study examples that I've spoken about being Klarna and AstraZeneca. I would personally want both these companies to raise as much interest in funding as they can, but we all know that that was not true for one of them back in 2015. Because while the Sustainable Development Goals and our varied and well-known frameworks and metrics give us a language that we've long lacked, they've helped us create a sense of urgency, and they've also helped us prioritize purpose alongside profit, even if not always over profit. They're not a be-all end-all. Just having them in place, measuring ourselves against them, trying to tick as many boxes as possible is not going to be enough in the next decade of capitalism. In fact, I would argue that it was never enough. And to illustrate the point that it was never enough, I'm going to call out some points from the recent Donut Economics Action Lab report. So Donut Economics Action Lab, or DEAL, is a community interest company that's working towards new economic thinking. And they recently released a report called The Social Shortfall and Ecological Overshoot of Nations, where they detail how for at least the last 30 years, no country has met the basic needs of the residents at a globally sustainable level of resource use. What's interesting is that between 1992 and 2015, when actually countries knew that they were being measured and everyone was trying to do something towards being more socially and environmentally sustainable, across 10 out of 16 parameters that Donut Economics looks at, more countries have fallen below the threshold in 2015 than in 1992. So, of course, there were 6 metrics that more countries met the bar for, and those are life expectancy, nutrition, sanitation, income poverty, secondary education, and access to energy. But I'm personally more interested in the places where performance measurement did not help us. So I would personally categorize it into 3 categories. One is priorities where there's a need for systemic transformation, and we don't know where to begin. Example, social support. Second, the priorities where there is not a business use case yet. For example, at some level, equality and democratic quality, at least in 1992. Because today, we do know that most companies have a very diverse customer portfolio. And so it's in their business interest to actually embrace diversity and equality. But back in 1992, there was no clear business use case, not even until early 2000s, I would say. And the third category is priorities where we've not had a massive failure as a humanity. For example, biophysical factors. Of course, even as of 2015 or before, there was a climate emergency that was coming up, but not everyone was clear or confident that this was happening. So to summarize, I believe that we start making progress when we measure performance, but only as long as it is in an area that we believe is incredibly important. Either because there's a business use case for it, or because the system is fully broken. And more often than not, it's both. In other words, I think regardless of how well thought through our performance measurement systems are, when they're not accompanied by strong cultures and value systems to incorporate them, we can't fully establish them in our lives, organizations, or countries. So I would digress here a little bit and actually talk about a personal story. And the reason I'm interested in systems change, probably a little bit more than performance measurement. I come from Tamil Nadu in India. And one of the things that I've been very proud to share with my classmates over the past couple of months is that I don't have a last name. So what you see on the screen, C or Chokalingam, is actually my father's name. Because in the 1960s, there was a huge social uprising in my state, and they got rid of all the last names because they thought last name was indicative of class and caste. Around the same time, we also had a national performance measurement system put in place to urge us to create a casteless society. The Reservation Policy constituted by Dr. Ambedkar. And Dr. Ambedkar was an incredible leader and first and foremost a rationalist. So when he did introduce it, I think he said something like, in 50 years, if we're successful, we should be able to let go of this policy. Today, we are 70 years in, and we're not yet in a place to let go of the policy because we've been chasing representation of minorities in terms of numbers and haven't really made progress in terms of cultural transformation. And that is what I would like to submit today. The fundamental flaw with how we approach incorporating performance measurement, in my opinion, is that we are fairly reactive and we only recognize the things that matter to us after they're long broken. We know the importance of vaccines today because we've broken the public health system. We know the importance of carbon emissions today because we've created a climate emergency. We know the importance of diversity and inclusion metrics today because we've created massive inequalities and let them go on for too long. After we've broken the system, taken it apart, seen the importance of each constituent part, we try and put it back together. Even our metrics are defined such that we spot and reward heroes and saviors who help us put broken systems back together. We fail to recognize and support those that keep the systems together in the first place. For instance, back in 07-08, when the financial crisis was coming up, of course, at that time, we did not recognize the genius of Professor Nazim Nicholas Taleb, who predicted financial crisis after financial crisis and even became financially independent because of it. But we also did not recognize the potential and knowledge we had within our own organizations. I would argue that at that point in time, almost every single organization that took a major hit had within it people who understood what was going on, why it was going to fail, and what could be done to prevent it. But they only lacked the leadership and systems to allow them the space to speak up, be valued, and lead. Almost 12 to 13 years later, when we come out of another crisis today, I would like to close my speech by nudging us to think, are we as leaders willing to listen to, value, and even follow the leadership of such radical thinkers and leaders with lived experiences at different levels of our organizations? Are we able to go beyond just chasing extrinsic metrics and measures and truly work on the basis of what we know as good and right in our hearts? I want to end with a quote from Kate Raworth, the author of Donut Economics, the book that started a movement. The most powerful tool in economics is not money, nor even algebra. It's a pencil, because with a pencil, you can redraw the world. Thank you.
Thank you so much, Lakshmi. That was an incredible provocation, and we really enjoyed your remarkable insights. So that finishes us up today for the day 2 of the Oxford Economics of Mutuality Forum. We hope to meet you back here tomorrow, where we will be discussing the future of investment. We'll have another great lineup of speakers and an opportunity for you to engage. Have a wonderful day, and thanks for being here with us.